The cycle of boom and bust has always existed, yet most investors fail to capitalize on the market correction when it comes. Warren Buffett famously says, "Be fearful when others are greedy, and greedy when others are fearful." So, will you be ready to buy when the market hits rock bottom? Or will fear paralyze you? Stay tuned because we'll explore how to prepare for potential downturns, ensuring you are equipped to make informed decisions when the market takes a turn for the worse. Number 1. Warren Buffett thinks a crash is inevitable. Warren Buffett, often referred to as the Oracle of Omaha, has spent decades mastering the art of deciphering the subtle signals of financial markets. His belief in the inevitability of a market crash isn't based on wild speculation or anonymous headlines. It's rooted in a deep understanding of market cycles, human behavior, and history repeating itself. Buffett's view on crashes is straightforward. They are not anomalies, they are certainties. Every boom eventually gives way to a bust, and every period of euphoria is followed by a sobering correction. In his 2017 annual letter to Berkshire Hathaway shareholders, Buffett warned that market declines of 50% or more are not only possible but inevitable. His reasoning: human nature itself, as long as greed and fear govern the markets, cycles of overvaluation and correction are bound to occur. Take the dot-com bubble of the late 1990s as an example. Investors were pouring money into tech startups, many of which had no earnings or even clear business models. The euphoria was so intense that anyone who questioned it was dismissed as out of touch. But Buffett didn't waver. He famously avoided tech stocks during that period, calling the frenzy unsustainable. And when the bubble burst in 2000, wiping out trillions of dollars, Buffett's cautious approach proved prescient. Fast forward to today, and the signs of speculative excess are once again glaring. Whether it's meme stocks, cryptocurrencies, or tech companies with stratospheric valuations, Buffett sees echoes of past bubbles. In his understated yet direct way, he has hinted that many of these assets lack the solid fundamentals required to weather economic storms. His decision to accumulate over $100 billion in cash isn't just a defensive move, it's a signal. Buffett doesn't hoard cash without reason. He's preparing for what he knows is coming, a period of economic correction that will present golden opportunities for those ready to seize them. Another reason Buffett anticipates a crash lies in the broader economic landscape. Rising interest rates, record high debt levels, and global geopolitical tensions create an environment ripe for volatility. In such a climate, he understands that the market's euphoric highs can't be sustained indefinitely. The lesson here isn't to fear crashes but to recognize them as part of the natural rhythm of markets. For Buffett, crashes are less about disaster and more about discipline. They reward the prepared and punish the reckless, separating true investors from speculators. And that's why Buffett's quiet warnings aren't just predictions, they are calls to action for anyone paying attention. If you're enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money making strategies, click the link in the description to start your financial journey. Number 2. Buffett's strategies for market crashes. When markets tumble and panic sets in, Warren Buffett doesn't flinch. Instead, he leans on strategies that have consistently turned financial crises into golden opportunities. These strategies aren't based on complex algorithms or speculative plays. They are built on timeless principles of discipline, patience, and value. One of Buffett's most famous strategies during market downturns is his ability to be greedy when others are fearful. Consider the financial crisis of 2008, a period when the global economy seemed on the brink of collapse. While most investors were scrambling to sell, Buffett was making bold moves, pouring billions into companies like Goldman Sachs and General Electric. But this wasn't reckless risk-taking. Buffett negotiated favorable terms, including high interest rates on preferred shares and options to buy common stock at a discount. These investments ultimately netted Berkshire Hathaway massive profits when the markets recovered. A key part of Buffett's approach is maintaining a war chest of cash. His philosophy is simple. Cash is not just for safety, it's ammunition for opportunity. When others are forced to sell quality assets at bargain prices during a crash, Buffett has the liquidity to buy. For example, during the 2008 crisis, Berkshire Hathaway had over $20 billion in cash reserves, enabling Buffett to act decisively when opportunities arose. Today, that same mindset is evident, as Berkshire holds a staggering amount of cash, signaling his readiness for the next downturn. Buffett also stresses the importance of understanding the intrinsic value of a business. During the dot-com crash of the early 2000s, he largely avoided tech stocks because he couldn't see their long-term value. Instead, he focused on companies with proven business models and enduring competitive advantages like Coca-Cola and American Express. These investments weathered the storm and continued to generate returns, reinforcing his belief that quality businesses can survive and thrive even in tough times. Another strategy Buffett employs is staying calm amidst chaos. While headlines scream doom and gloom, Buffett reminds investors to stay focused on the long term. Markets, he often says, are voting machines in the short term but weighing machines in the long term. This mindset helps him navigate crises like Black Monday in 1987, where he calmly assessed the situation, stayed invested, and emerged stronger. Buffett's strategies remind us that a market crash isn't the end, it's a test of resolve. For those who prepare, stay rational, and act with conviction, a crash can be the beginning of incredible wealth-building opportunities. It's not about timing the markets, but about being ready to act when the tide inevitably turns. Number 3. What you can do to prepare. Preparing for a stock market crash isn't about panic, it's about strategy. And no one understands this better than Warren Buffett, who has weathered more financial storms than most of us will ever see. If you want to thrive when the markets dive, it's not about predicting the crash, but positioning yourself to take advantage when it comes. Buffett has long emphasized the importance of building a solid financial foundation before storms hit. Think back to the global financial crisis of 2008. Millions of people lost their savings because they had no safety net. Meanwhile, Buffett, with billions in cash reserves, was ready to deploy capital into undervalued opportunities. The takeaway? Start with an emergency fund. Having liquid cash to recover at least 6 months of expenses shields you from being forced to sell investments during market lows. Next, Buffett champions the idea of investing in what you understand. During the dot-com bubble of the early 2000s, tech stocks were skyrocketing as everyone was jumping in except Buffett. He admitted he didn't fully grasp the value of many tech companies, so he stayed out. When the bubble burst, Buffett avoided massive losses. His lesson: don't get caught up in hype. Stick to industries or companies where you can clearly see long-term value. Buffett's advice also underscores the power of diversification. He compares investing to baseball. You don't have to swing at every pitch, but when you do, aim for solid hits. By holding a diversified portfolio of quality stocks, bonds, and other assets, you can mitigate risks. During the crash of 1987, many investors who had a mix of investments saw fewer losses than those fully exposed to equities. Timing the market might sound appealing, but Buffett has consistently called it a fool's game. Instead, focus on dollar cost averaging. This strategy, where you regularly invest a fixed dollar amount in a specific investment regardless of market conditions, allows you to buy more shares when prices are low. Over time, this approach smooths out volatility and lets compounding work in your favor. Besides, preparation isn't just financial, it's emotional. Buffett says the market ups and downs are inevitable, and panicking is the surest way to lose. He once recounted how, during the 1974 market downturn, a journalist asked him how he felt as his net worth dropped significantly. His response? He was excited because stocks were getting cheaper. This mindset is crucial. View crashes not as disasters but as opportunities. By following Buffett's timeless principles, building cash reserves, focusing on quality, staying diversified, and maintaining a calm, opportunistic mindset, you can prepare for a market crash not with fear, but with confidence. The key isn't avoiding the storm, it's learning how to navigate it and come out stronger. Warren Buffett once said, opportunities come infrequently. When it rings gold, put out the bucket, not the thimble. The next market crash will be a test, not of the economy, but of your discipline and preparation. Will you panic and retreat? Or will you seize the moment and build wealth like the Oracle of Omaha himself? If you like this type of content, then press the like button and subscribe to our channel.